Welcome to The Explainer. Today, we're unpacking a really fascinating contradiction surrounding an absolute global titan of science and technology, Danaher Corporation. We're going to look at a massive leadership pivot, their Q2 earnings, and a wild market reaction that frankly left Wall Street scratching its head. So let's get right into the data. Okay, let's dive into this, because to really grasp the scale of what we're looking at, you have to understand the sheer size of Danaher. As of August 21st, 2026, their market capitalization sits at a staggering $151.8 billion, with shares trading around $218. I mean, this is a global behemoth. We're talking about 60,000 employees worldwide, operating heavily across life sciences, diagnostics, and biotechnology. They are an absolute heavyweight in the bioprocessing equipment used to manufacture biologic drugs. So, when a giant like this makes a move, the entire market feels the ripples. And that brings us to the core mystery of our explainer today. On July 21st, Danaher dropped its Q2 earnings report. And by most traditional metrics, they totally knocked it out of the park. Yet right after that report came out, the stock plummeted, down about 14% in a single day. Think about that. That's a massive haircut for a $150 billion company. So how does that happen? How do you post a huge win on paper, but completely lose with the market? Well, analysts call this a classic beat and cut scenario. If we look at the beat metrics, revenue came in strong at $6.3 billion. Their adjusted diluted earnings per share hit a $1.94, which easily beat estimates. Net earnings skyrocketed 60% compared to the prior year, and they generated a massive $1.3 billion in free cash flow. Those are incredibly healthy numbers, right? But then there's the cut. Danaher lowered the upper end of its full-year core revenue growth outlook from 6% down to 4%. The market saw that future guidance get trimmed, and honestly, panic just set in. But what makes this reaction even more perplexing is how well the individual segments actually performed in Q2. Let's break it down. Life sciences. They delivered their strongest quarter in several years, growing 5.5%. High-growth markets, which notably includes China, jumped an impressive 10%, which really shows that the impacts of volume-based procurement over there are finally starting to cool off. Biotechnology was up 2.5%, and diagnostics grew 2%. And actually, if you exclude respiratory testing, that diagnostic growth was more like 5%. Across the board, the engines are firing. So if the segments are so healthy, why cut the outlook? Well, the culprit was highly specific, a $100 million bioprocessing shipment delay. Now, to be clear, this wasn't lost revenue. It was just a shift. Customer site readiness issues and some production schedule changes meant that $100 million in chromatography resin revenue, mostly from Q2 and Q3, had to be pushed from 2026 into 2027. And look, Wall Street notoriously hates uncertainty and delays. This single shift in timing is what primarily triggered that 14% drop. But earnings are just one piece of the puzzle. Right on the heels of this Q2 turbulence, Danaher aggressively started changing its shape for the future. Which leads us right into our first big transition. Strategic leadership shifts and a new era for Danaher. On August 3rd, the board of directors announced a major shakeup. Current CEO Rainer Blair is stepping down, and Julie Sawyer Montgomery is stepping up as president and CEO, effective October 1st, 2026. But what's really vital to notice on this timeline is the overlap. Blair isn't just handing over the keys and walking out the door. He's going to stick around as a senior advisor all the way until March 31st, 2027. This is a highly structured, incredibly seamless transition plan, clearly designed to project stability to shareholders. So you might be asking, why Julie Sawyer Montgomery? Well, she joined the company back in 2017 and has been leading the diagnostics platform. Just look at these numbers. Under her leadership, that segment's revenue grew from roughly $6 billion to $11 billion today. Even more impressively, she approximately tripled their operating profit. On top of that, she's been the driving force behind some of the company's most aggressive, large-scale growth strategies recently. And this brilliantly illustrates exactly the kind of bold strategic vision she brings to the table. $9.9 billion. That is the massive scale of the Masimo Corporation acquisition, a deal that she directly helped champion. If you don't know them, Masimo is a leading specialty diagnostics provider. Danaher acquired them for $180 per share in cash, closing the transaction on June 10th. And let me tell you, this wasn't just some vanity purchase. Masimo delivered high single-digit revenue growth in just the first half of 2026. So this acquisition fundamentally strengthens Danaher's already robust diagnostic segment, and it perfectly aligns with their long-term strategy of expanding into high-growth, high-margin areas of healthcare. It's essentially a foundational building block for the new CEO's tenure, one that diversifies their revenue away from some of that bioprocessing volatility we just talked about. Let's shift gears to look at Wall Street's verdict, checking in on institutional moves and analyst sentiment. So, with a new CEO, a major acquisition, but a 14% retail panic drop, how are the heavy hitters actually reacting? Well, they're remarkably calm. In fact, institutional confidence is sky high right now. Institutions currently own somewhere between 79% and 83% of all outstanding shares. And guess what? They're buying the dip. On August 21st, the Bank of New York Mellon Corp disclosed that they acquired over 932,000 shares, valued at roughly $671 million. Look, when the smart money drops over $500 million right after an earnings scare, it tells you they believe in the long-term fundamentals way more than the short-term noise. Now, what's really interesting here is the overwhelming consensus among professional analysts. Out of 25 to 26 polled, 19 rated a buy, 5 say hold, and 1 actually has it as a strong buy. Notice something missing? There isn't a single seller rating up there. This broad, moderate buy to buy consensus proves that the folks whose literal, full-time job it is to value this company view that recent 14% drop as a massive overreaction to a simple scheduling delay. You can see this confidence perfectly reflected in their recent price targets, too. Look at this really narrow, optimistic range. We've got Morgan Stanley at $220, Barclays at $230, Deutsche Bank at $240, and HSBC at $230. The average target sits right around $228.91. Given the stock was trading around $218, these analysts are implying a solid 5 to 6% upside in the near term. Plus, the stock is already trading well above its 50-day and 200-day moving averages, which shows some really strong technical momentum. All right, let's zoom out and look at the big picture, weighing the long-term opportunities against the real risks. The tailwinds for Danaher are incredibly robust. Remember that $100 million delay in bioprocessing? Well, the underlying demand isn't the problem at all, because orders for bioprocessing actually surged by a mid-teens percentage in Q2. The industry is clearly hungry for their equipment. They are also uniquely positioned right at the forefront of precision medicine, AI diagnostics, and CRISPR therapies. Financially speaking, they even raised their full-year adjusted EPS guidance to a range of $8.45 to $8.60. And if you look at fair value estimates, the company might actually be 8 to 12% undervalued right now. However, as focused learners, we've got to look at the whole board impartially. The headwinds are very real. That $100 million revenue shift absolutely does create near-term unpredictability. Danaher also faces some evolving policy and reimbursement frameworks in China, which, as we saw, is a major growth market for them. Plus, there's broader weakness in early-stage biotech funding, and that could potentially cool demand down the line. We also have to acknowledge the natural execution risk that comes with any major CEO transition. And finally, data shows about $245.7 million in recent insider selling over the past 12 months, which some investors objectively view as a cautionary signal. Which leaves us with this provocative final thought. We are looking at a company trading at a forward PE of 24.4x. They are navigating some very clear near-term headwinds, like revenue shifts and China policy risks, but they're armed with massive institutional backing, a dynamic new CEO, and a brilliant $9.9 billion strategic acquisition. So is this strategic pivot a classic case of an undervalued giant being temporarily misunderstood by retail investors? As always, take this data, do your own due diligence, and decide for yourself. Thanks for joining me for this explainer, and keep learning.